Morning, everyone. We'll be starting on
There you are.
Sorry about that, everybody. A little technical difficulty. Not sure why I got kicked off, but anyway, good morning. Thank you for tuning into our presentation. We have a great speaker today who's going to share the latest information available on President Biden's Build Back Better, or BBB, agenda and tax plan. My name is Patrick Gardner, and I'm a loan officer with Guarantee Mortgage and chair of the Education and Events Committee at SFAR. And on behalf of the committee and myself, I'd like to welcome you to our Zoom call today. As we get started with the meeting, I want to share a few logistical pieces for you. All Zoom audience viewers are on mute throughout the entirety of the presentation. The webinar is being recorded and will be available to view on the SFAR YouTube social page, likely either at the end of this week or early next. If you do have questions, please ask them through the Q&A box located at the bottom of your screen marked Q&A. We will not be monitoring the chat feature during the presentation, but we'll be answering the questions asked through the Q&A box at the end. If your question is not answered to the degree that you would like, please feel free to reach out directly to our presenter with the contact information listed on the presenter's contact page at the end of the presentation. All right, on to our guest speaker, tax attorney for today's discussion, Raul Escatel. Raul is a senior partner at Ascendant Law Group LLP and focuses his practice on advising individuals and businesses on a wide range of international, federal, state, and local tax issues. With over 12 years of experience as a government tax lawyer, Raul has a particular expertise in successful resolution of tax disputes at the federal, state, and local levels. Raul is a certified tax specialist by the State Bar of California and has a master's in taxation law. He is licensed to practice in California and before the U.S. Tax Court. Raul will be discussing the Biden administration's proposed changes to the federal tax code. President Biden campaigned on increasing taxes on the wealthy and undoing many of the tax cuts introduced by the Tax Cuts and Jobs Act under the Trump administration. Over the weekend, the House and Senate Democrats remained focused on hashing out the specifics of the proposals contained in the BBB budget and agenda, all factors seem to indicate that federal income taxes are likely to increase at the start of 2022. Raul, thank you for joining us this morning and diving into this timely topic. It is a lot to unpack these proposals, and I hope and how they may impact real estate sales, estate planning, and investments moving forward. I'm going to turn this presentation over to you now so you can give us the lay of the land and help build a context for what we can expect in the coming months and years under these proposed changes.
Okay, great. Thank you, Patrick. Good morning, everybody. So today we're going to talk about what's going on with these, tax proposals you've been hearing about. There's been a lot of, let me just get through these. There's been a lot of noise about what taxes are going up, for whom, and what industries, right? So, as Patrick said, Biden campaigned on basically undoing the Tax Cuts and Jobs Act that was enacted under the previous administration. And the reason being is basically for the 2022 budget, it's in order to do a lot of infrastructure. The proposals are meant to cover the expenses dealing with childcare, education, climate change, and and to tax the upper 1% of the American population. So how do we get here? What's going on? So President Biden's proposal is what's called the general explanations of the administration's 2022 revenue proposal, or as it's commonly known to tax lawyers, the Green Book. This basically explains all the proposals that Biden and his administration have put forth regarding any tax changes. And what it did is it provided details on some of the proposals that were included in President Biden's American Jobs Plan and its American Families Plan. These were two separate packages that contained changes to the tax code. And so they were both, all of those proposals are contained in the Green Book. On September 13th, the House and Ways Committee introduced their proposals, some which are similar to the Green Book, but others which are not. And we're going to actually focus on some of those differences. And it's known as a Build Back Better Act. And on September 14th, the Joint Committee of Taxation report released more descriptions on all of the proposals put forth by the House of Representatives. Also, too, on August 11th, I should say, the Senate passed with their budget resolution, which then went back to the House. So this becomes important because when we talk about, you've been hearing this term about reconciliation, right? So basically what this is like the budget has been set forth by the Senate. Now, what the House has, they can basically add and make changes to based on the reconciliation process. And what it basically does is it allows that reconciliation to go back to the Senate and pass by a simple majority rather than a filibuster. So I'm not going to get too much into reconciliation right now, but when you hear that, the reconciliation bill and a simple majority, that's what it means. It means that now that the budget is in the House, that the House can send it back to the Senate and the Senate can pass that budget through reconciliation by a simple majority. So you might have heard of some of the changes, especially in real estate, 1031s, loss in the step-up basis. Some of these were contained in the American Families Plan. So this was one of the first proposals that was put forth by the Biden administration, which restored the top marginal tax rate, long-term capital gains for over $1 million, the elimination of the step-up in basis, carried interest, the limitation on like-kind exchanges, and other provisions. Now, so that was what's contained in the Biden proposals, which we'll talk a little bit more as we go along to basically inform you as to what proposals that were set forth by Biden are still at play here. There's been some confusion about that. So, like I said earlier, right now, the Ways and Means Committee in the House, they put their proposals, which is, the Build Back Better Act. which basically, the whole point is to earmark $3.5 trillion to provide funding, establish programs, and otherwise modify provisions relating to housing, rental, homeowners assistance, education, childcare, health care, and the environment. So how are we going to pay for that? And this is where all the tax increases come into play, right? So that's where it's the House. How are we going to pay for the Biden's infrastructure plan? So first, what we're going to talk about, we're going to do like an overview of the proposals. So in the Green Book, what Biden put forth was one of the big ones was to raise the corporate tax rate, which he campaigned on as well. Throughout his campaign and in his presidency, Biden wants to raise the corporate tax rate from its current level of 21% to 28%. In addition, and something that hasn't been talked to a lot, and we're not going to talk about it here, but a lot of the actions happening in the international tax arena, and one of the things that's been put forth is like a minimum tax of 15% of a global minimum tax. And this is still kind of going on, but it looks like it might go forth. There's a couple of countries in Europe that are against it, Ireland being one of them, but that's also going on its path basically to create this worldwide 15% tax. So, no matter where the corporations go, they're going to be taxed. And Biden in his proposal put a 15% tax on certain large corporations. You can ignore that last one. So the House Ways and Means proposal, when it comes to the corporate tax, is they're looking at a maximum rate of 26.5%, which is going to be basically incremental. So, it's 18% for income under 400,000, 21% for taxable income over 400,000, but not over 5 million. And, top tax rate of 26.5% for income over $5 million. And there's this clawback provision. This was actually already in place before the Tax Cuts and Jobs Act under the previous administration. It's a clawback provision where large corporations are taxed 3% of the corporation's taxable income in excess of 10 million or $287,000. So now let's talk about some of the proposals affecting individuals. So what Biden said, so he wanted to raise the top tax rate to 39.6%, which would be up from 35 and 37% on ordinary income and short-term capital gains. What this translates to is like single filers with taxable income over 452, married joint filers with taxable income over 509, married filing separately with income over 250, and head of household with income over $481,000. And the effective date is 2022. One thing that I get a question a lot about, and I'll say it now, is whether or not some of these tax changes are going to be going forward or going back or retroactive, as we say. As a general rule, most new tax proposals are prospective, meaning they start in the next taxable year. However, there's a couple that are going to be in the various proposals that are not going to be prospective. They're going to actually be retroactive. Excuse my typo here, but this should have been, starting in 2022 for the under Biden's. Now look at the difference. Under the Ways and Means Committee, the proposal is it's similar to Biden's proposal, with a 39.6 being the top rate. However, the thresholds are a lot lower. If you look at here, the single filers, it starts at 400,000, with married filing joint starting at 450, married filing separately with 225, and the head of household at 425. So those two proposals are similar in that they both want to reinstitute the 39.6% tax rate. However, the House's proposal seeks to impose that threshold at a lot lower level. So, I always tell people, like, who's going to be affected by a lot of these tax cuts? And you'll see, these tax hikes, I should say, and it's 400,000 seems to be the magic number. When we start going over 400,000, this is where a lot of these provisions start kicking in. So another one that's been mentioned a lot is the increase in the capital gains rate. So under Biden's proposal in the Green Book, he proposes to raise the maximum rate of 39.6% for high income individuals. And that would apply basically to taxpayers with adjusted gross income in excess of $1 million. So, and also this was in one of the things that was also discussed is when is it going to happen? So under previous discussions, the increase to the cap gain rate was going to start in 2021, whenever the transaction occurred. It wasn't specified, but one of the things that was talked about a lot was, well, for any basically starting in 2021, so they would be going retroactive, right? So, however, now in the House, what we have is the House is proposing a top rate of 25%. So that's it. So right now where we're at, and it looks like it's more going to be 25% rather than the ordinary rate, which people have been hearing a lot about and freaking out about. So all indications seem to indicate, all signs seem to indicate, I should say, that it's 25% might be the rate that we're looking at for capital gains. And also, as opposed to Biden's plan, as opposed to Biden's plan, which was basically the capital gain threshold would be based on your ordinary rates. I'm sorry, I got it mixed up. The House's proposal, Biden would put a flat 39.6% on all capital gains over $1 million, whereas under the House proposal, the cap gain threshold would be in line with the ordinary income thresholds. So it'd be a progressive increase in the rate based on your ordinary rate. And so, and for this proposal, this sets in September 13th of 2021. They call this the transition period from now until the end of the year. So basically, if this passes for any capital gains, for any transactions that result in capital gains after September 13th, the new 25% rate will apply. So you should keep that in mind. And also, I mean, if for whatever reason the Biden proposal occurred, the 39.6% would apply for the 2021 tax year. Another proposal that is that's been talked about is the net investment income tax. We call it the NIT. So this is already this already exists. However, what under the previous rules, the NIT only applied for where there was a material participation requirement, right? So where there was, if someone was actively conducting their business operations, the NIT would not apply. However, now under the new proposal, the material participation requirement is irrelevant. So it applies whether it's active business, active trader business, or just passive investments. The 3.8% NIT is going to apply based on modified adjusted gross income. And the threshold amounts are for basically, so the NIT's going to apply for $500,000 for joint filers, $250,000 for married funds separately, and $400,000 for all others. And the Treasury is going to release a certain clarification elements. For example, like the NIT won't apply for certain income that's already being subject to like federal employment taxes, but the Treasury is still looking at releasing more clarification regarding the NIT and its application. But like I said, these are just still proposals, but this is one that's coming out of the House right now. Another one you might have heard of is the limitation on the Section 199 Cap A deduction. As you might know, it permits non-corporate taxpayers a deduction of potentially 20% on their combined qualified business income, subject to certain limitations, right? So what this does is this would put threshold amounts on who can claim the deduction. So like before, it's 500,000 for married filing jointly, 250,000 for married filing separately, $10,000 as applied to a trust, and 400,000 for everyone else. There's again that $400,000, and everyone else would be like individuals. The effective date for this would be December 31st, 2021. And we'll talk a little bit up at the end, like a little bit of tax planning. Like if we know that there's going to be a limitation on this based on the threshold amounts, maybe some planning this year is if your business is eligible for the 199 Cap A deduction, maybe if that business could basically recognize some of that income now versus next year, that might be very beneficial. Because starting next year, these threshold amounts will limit the amount of the deduction that can be taken. Okay, another one that's this is basically affects excess losses. So Section 461 of the code limits losses that can be used to offset income. This is we're talking about net operating losses. Under the Tax Cuts and Jobs Act, there was a certain limitations that were placed on him that were going to set to expire on December 31st, 2026. The proposal out of the Ways and Means Committee would make the limitations permanent. So this would substantially change the way that businesses can claim losses and how they're calculated and how much of those losses they can carry forward and whether they can carry them at all. So this is a big one that's being watched. Excuse me here. Another one is that's coming out of the Ways and Means Committee is this new tax surcharge, which would apply to it's a 3% income tax on individuals, estates, and trusts with a modified adjusted gross income of above certain thresholds. So here we see for individuals filing single, head of household, or married filing jointly, the threshold would be 5 million. So this would be a new tax on top of the. So now we have we have the increase to the ordinary income tax rate. We have the net investment income tax, and now we have the 3% tax. So as we go through this, you're going to see they're going to start piling up. And so this tax applies to individuals over 5 million and married filing jointly. Individuals filing married filing separately is 2.5 million, and trusts over $100,000. Big difference in that one. So this one's brand new. One thing you might have heard about is the estate and gift taxes, which is going to reduce so the House proposal, actually both proposals aim to reduce the exemption to $6.6 million in 2022, which was so the state and gift taxes were going to go back to their pre Tax Cuts and Jobs Act to the previous levels in 2026. What basically this does is, and some of these other provisions too, they basically accelerate what was going to happen anyways. So when we look at the tax rates, the marginal tax rates for individuals, those were going to go back to the previous levels in 2026. Same here with estate and gift taxes. They were set to expire the tax cuts in 2026. So basically what the Democrats are looking to do is by using some of these acceleration for some of these provisions to pay for the Biden's agenda now versus waiting until 2026 to make this happen. So that's some of the finagling that's happening right now is in order to pay for some of the Biden's agenda is to accelerate some of these sunset provisions for some of the tax cuts that were made under the previous administration. One of the we're not going to get too much into this, but this is a very there's certain rules that are going to be changed for grantor trusts. So in a nutshell, basically is there's this for certain trusts, an individual for income tax purposes, an individual is taxed as the owner of the trust and is not viewed as the owner for estate taxes. And so what the proposals in the House wants to do is basically, if you're the owner of trust property for income tax purposes, you're also considered the owner for estate tax purposes. This is a very popular, you see the intentionally defective grantor trust, we call them IDGITs. They're very popular for high net worth individuals in terms of planning. A couple of my partners, they do these all the time, and they're like scrambling to find a workaround, because this is a very popular method for creating those dynasty trusts that and for ways for grantors of trusts to basically own property for tax purposes, for income tax purposes, but completely eliminate it out of their estate for estate tax purposes. One of the things I put is that what's the effect on irrevocable life insurance trusts? Because these kinds of trust islets are actually not, they are sometimes used by wealthy individuals, but not necessarily. And the way that these trusts, life insurance trusts, are designed, they would be subject to this new rule too. And those would actually, so, those actually might go away, because the whole point of setting up a life insurance trust is in order to get it out of your estate, but still having that trust make that payout upon the death of the grantor. Another issue in the estate and gift tax arena is estate valuation issues. That's going to change drastically. So that's one of the things that, in my firm, we're looking at, just because of some of the estate planning that we do, is that currently the way an estate is allowed to value its assets are not based on the best use, but they're based on how the owner of the property is using it. Where this comes into play a lot, the best example is farm property. So farm property, so farmers will have a piece of land that they use for crops, but that's not necessarily the best, especially now in California with development. It's not necessarily the best use of that property. It could probably be worth a lot more if it was, if it was sold for, to build housing subdivisions, right? So that's going to change drastically. And so that's one to look out for, because that will change how real property is valued for going forward. This one's still kind of being debated, so I don't know what's going to happen with this one. I was told to focus on Section 1031 exchanges because you guys all know them really well, right? So, I mean, there's really not a big thing here. Nothing really happened. So, under the Tax Cuts and Jobs Act, we know that the previous administration limited exchanges to exchanges of real property. What Biden's proposal sought to do was to limit the amount of deferred gain of $500,000 a year, or $1 million for people that are for taxpayers filing jointly. However, in the House, there is no mention of the like-kind, any changes to the like-kind exchange. So as it looks like now, there's not going to be any changes to the like-kind exchanges, apart from the fact that they're limited to exchanges of real property. I don't see that changing based on what I'm hearing in the rumblings of in the House. So just so you know, like, my context for a lot of this stuff is this is like my fourth presentation on this. And I've been the moderator. This is the first time I'm actually presenting. And some of my panelists work, they're all like lobby groups like the U.S. Chamber of Commerce, the Joint Tax Committee, and Tax Policy Institutes. So, the people that I've been consulting with have their ear to the ground and are like constantly following this. So what I'm giving you is basically the best information I can have as of 9 o'clock this morning. So there you go. Okay, once again here, and this was, like I said, Biden had, one of the things about kind of demystifying all of this is knowing where we're at in these tax proposals. So, like I said, the limitation on like-kind exchanges was in Biden's American Families Plan, right? So now we're in the Build Back Better Act that's been put forth by Congress, And that's kind of like, when we're tracking this, it's like, where is it at in the process? And so where we're at now is that, I guess, okay, yeah, so the house plan did not mention this. That's where we're at. And so, like, again, too, like a lot of people are freaking out about the elimination of the step up in basis. That was also not mentioned in the in the House bill. So, what I'm trying to give you is the information based on what's coming out of the House and where it's likely to go when it bounces back to the Senate. So for our purposes, like for real estate, trying to focus on real estate, the big ones, we're going to be 1031, and we're going to be the rise on capital gains. A couple of other breaks that are included in the House plan that may happen are basically, there's an exemption for $25,000 of passive loss for rental losses associated to rentals. The depreciation write-offs are going to probably go away as well. And as I mentioned earlier, the elimination of the Section 199 Cap A deduction from income from rental properties. So those are the ones that you need to be aware of as real estate professionals. And yeah, because we're going to talk a little bit about at the end about if we get some time, Prop 19, but because that's basically California's version of getting rid of the step up in basis. But as far as for real estate professionals, those are the ones that you need to know. Also, I didn't put it up here, but one of the things that was eliminated under the previous administration, which might hopefully get brought back, is casualty losses. Casualty losses were severely curtailed under the previous administration, and they're thinking about bringing those back because before individuals had claimed casualty losses for like fires are a big one. Right now they've been doing for the past 4 years carve outs for specific instances like hurricanes and some of the California wildfires for casualty losses for individuals. However, before that, you could claim a casualty loss whenever. There didn't have to be like a presidential declaration or saying that X event is considered a disaster for purposes of claiming a casualty loss. Now they're hoping to bring that back, and that's one I've been tracking too, because when I was in the government, I used to do a lot of casualty losses, and that in California, we have a lot of stuff going on here, so that would be really good to have that for individuals suffering from, whether it's beach erosion or it's wildfires or earthquakes. So that's casualty losses. One look up, one I've been kind of tracking, but I didn't put it up here. But that's one thing that might be of interest to real estate professionals as well. Another one that I've been getting a lot of questions on is what's going to happen with the state and local tax deduction. So, what's happening in the House right now is Democrats are split. They want to, get rid of it. Representatives from New Jersey, California, New York. And so what looks like it's happening, there might be a compromise, because the way it's working, especially now with Senator Sinema from Arizona's refusal to raise any kind of taxes, it's looking a lot less likely that the SALT deduction will be brought back, or the cap will be repealed, I should say. There might be a compromise, which they're looking at. One of the latest I read this past weekend was like doing basically a 20 to 25,000, raising the cap for the deduction, and having it as opposed to, like, one of the proposals was to repeal it for 1 year, or to increase the cap and let it go on for longer period of time. So that's where it's at right now. And based on what I've heard is, like, it might be there might increase the cap and do it for a period of years. So we'll see what happens with that one. So what's next? So As Patrick mentioned earlier, the Senate and House Democrats are focusing on finalizing the provisions in the reconciliation bill. They are scheduled to meet next week. The Democrats have imposed a deadline for themselves of October 31st in order to pass something. So we'll see what happens there. And, one of the things, though, and you've heard on the news, it's becoming increasingly difficult because Senator Sinema is basically indicating that she doesn't want to raise any taxes, neither to individuals or corporations. So that's going to make it a little difficult in order to be able to pass President Biden's agenda and how to pay for it, right? So that's why it's like this is an ever-changing and evolving discussion regarding what tax proposals are going to pass, right? So what I gave you is, that's why I just gave you a big overview, because I even tell my clients, it's like, let's hold off until November before we do any kind of planning, significant planning, because things are changing as every time the House meets, something's going to change. So like I said, they're scheduled to meet next week. And another big date is December 3rd. I think that's when the extension to fund the federal government expires. So we hope to find more clarification regarding some of the proposals that have been put forth by the House and what's going to happen with them by then. So stay tuned for that. So okay, so sorry about that. So we'll briefly talk about Prop 19 because it's on everyone's mind. And most of you are familiar with it. Hold on a second. The Home Protection for Seniors, Severely Disabled Families, and Victims of Wildfire or Natural Disasters Act. So as you know, like the way Prop 19 works, there's two main components. We're talking about base value transfers for people over 55 and older, and fire victims, and the one that gets the most attention, the parent-child exclusion for primary home and investment purposes. So we know that, for the base value transfers, it occurred on April 1st, and for the parent-child transfers, February 16th was the date that it was put into play. So, how do Prop 13 taxes work now where a parent dies and leaves property to a child? So basically, the way that Prop 19's been kind of, and I way I look at it too, is like it's the way that California's gotten rid of the step up in basis, because it's severely limited to what the heirs of a piece of property are entitled to. So, we know that the requirements are that a parent's or grandparent's principal residence must also remain the principal residence of the child or children in order to get the exclusion. The exclusion is $1 million plus the assessed value previous to the death of the previous owner, and that the children and grandchildren must file for the homeowner's exemption within 1 year of receiving the property. And we also know that the exclusion is no longer available for other types of real property after the February 15th date. This includes commercial property, rentals, vacation properties, etc. So one of the things is, well, let me see if there's anything else here. Well, okay. So one of the things that, that's become kind of popular in planning now is, what if you have more than one child? And the properties, what if both children are not living in the same residence? So the way the law reads is that kids have to be living in the residence. So one thing that's become popular are what's called, when we're setting up estate planning, is getting the trustee to get a loan out to pay out one of the children and having the home go to one child, so the child is entitled to receive the entire exclusion. Otherwise, it'll fail. So one of the things, so that's one of the planning techniques. It's just basically, and this is only to cash out children that may not want to live in the residence. And this is something that, involves more estate planning than anything else. But it's, so you should be aware that, if there's a situation where you have more than one potential heir for the property and they're your children, and one of the kids wants to stay in the house, getting trust loans might be a way to basically remedy that situation and still allow yourself the exclusion under Prop 19. So one thing personally, I think this bill's poorly written and myself, and I think now that people are seeing the effects of Prop 19, they're not very happy with it. And as I'm presenting, there's already efforts underway to repeal Prop 19. There's already a couple of groups collecting signatures in order to put this on the 2022 ballot. So, yes, I mean, it's bad, but the way our proposition system works here in California, it's one day, it's just as easy it's just as it was this easy to get Prop 19 onto the ballot. Who's to say that, it won't be just as easy to repeal it by putting it back on the ballot. So me personally, I'm not as worried about this. And there's other, there are other methods of ensuring that you don't get the bite of Prop 19. That they involve some sophisticated estate planning, but for now, I say that let's wait and see what happens. I don't like to freak out unless I have to, and this is when I think that I just can't see it remaining on the books. But that's just me. So I know I ripped through this really quickly because I want to save time for questions. So okay.
All right. So Raul, first, thank you so much for delving into this. Clearly, it's a more complicated situation because we don't have finalized plans, budgets in place until November. So a lot of what you're talking about is theory and promotions, but not things that have been finalized. And that makes it kind of tough to conceptualize. So we appreciate you, dancing with the complexity of it. We do have quite a few questions, and hopefully more will come in as we roll through. Somebody asked a question in the chat, and we'll circle back to this one. They're basically asking, for you to spend a little bit more time on the ramifications of the elimination of the rental property tax cuts and how you recommend, realtors promote the benefits of rental property. So we can circle back on that one, but just on the back of your mind, if you can be thinking about that.
Okay.
First question, could you speak about and explain the following? Build Back America, you've already addressed this. It's basically the grantor trust issue.
Right.
So, how does that affect, particularly the wealthy who are building these as a way to kind of shield their wealth in a number of ways? Just, I guess, essentially the question is, and you've already said that some of your colleagues are struggling with this, so it's not a simple, easy answer, but basically how the grantor trusts work and what decisions are coming out that are affecting estate planning and how that works.
Yeah. So one of the things is as I said earlier, so the thing about we call them defective grantor trusts. Those are the ones that the proposal's targeting. is that it's where you treat the grantor is treated as the owner for income tax purposes, but not for estate tax purposes. So what this is going to do is, and the reason why that even happened was because back in the day, it was based on it was easier to be the owner of a trust, and because the rates for trust taxation were a lot different back when these statutes were written. So that's why there's a disparity there. So what this proposal wants to do is to kind of harmonize them and say, well, if you're going to be an owner for income tax purposes, you're going to have to also be an owner for estate tax purposes. So how they're used is, I like to say that these kind of trusts are like ATMs for really wealthy people. So you basically stick everything into your irrevocable trust. And what you do is you start doing transactions with your trust. Let's say you stick a piece of property in your trust, and you quote unquote, then you lease it back from your trust on these very favorable terms. And then what happened, or like, let's say like an interest only for 30 years. And then what ends up happening, a sale of a trust asset. And then at the very end, you just basically forgive the note. So it's a way to have things out of your estate, but you still kind of can use them. And it's very popular for high net worth individuals and these are people that, where the exemption amount is, where their wealth is far in excess of the exemption amount. So it's an easy way to circumvent the estate tax. And, one of the things was that the planning that we were doing this year was having anyone that, for individuals where their estate was in excess of the current exemption, which is what, 26 million, would say, make a gift now into one of these kinds of trusts. So this kind of like it's problematic, because now it's like the technique to use the entire exemption amount now is being complicated by the fact that the vehicle that we'd use to use up their exemption is now being targeted. Now one of the things that transactions, because the grantor is very, the way these trusts are used as a grantor can do a lot with transacting with the trust. But the transactions, what's going to happen now when a grantor transacts with his trust, that they're going to be looked at as if the transactions are viewed with like an uninterested party. So the transactions will now be taxed, as opposed to certain transactions that are conducted between a grantor and his grantor trust are, you can, I don't want to say game it a little bit, but they're easier to defer taxes on them. Now they're going to be looked at differently, and those transactions are going to be taxable transactions. I know it's a little, I'm being a little vague here, but it's a very complicated topic. I'd be more than happy to answer,
Well, so what I'm hearing you say is that the grantor's status has changed from something that was more flexible to now likely to be taxed under the new guides.
Yes.
Okay.
That is correct.
Well, that doesn't seem like the answer the extremely wealthy will want. So I'll have to come up with another strategy.
Yeah.
All right. Deborah asks, adjusted gross income relative to 400K. Is the 400K a target that the Biden administration is stating that is wealthy? That is, it seems.
Yeah. And you and I talked about this, Patrick. Yeah, it's in the Green Book, in Biden's proposals, it was all like everywhere in the proposals was $400,000. That seems to be. I was asking someone from this lobbying firm in DC who presented a couple of months ago, like, where did this number come from? And it was kind of random, actually. So I there was no real rhyme or reason, but 400,000 seems to be it was, gosh, I forgot something. It was like a number that was described for higher middle income, but back in the like 90s or something. So it wasn't even indexed for inflation. So, but that's where the number, the number was just,
Got it.
yeah, the White House side, that's what, wealthy is.
Jason asks, why the restoration of the marriage penalty? Any advice on how to cheaply get divorced every December 29th and remarried on the 2nd?
So, Jason, I'll answer this question like this. It took me 14 years to get married because I knew about the marriage penalty. One of the wisest things that one of my first mentors used to advise high net worth individuals in New York said that get married for ceremonial reasons, but don't get married legally. I guess there's no reason why you couldn't get married and divorced every year. But yeah, so the marriage penalties actually with the way the new tax rates are, it's going to actually hit married people a lot harder. I do agree with that.
All right. Carol asks a two-part question. Does the capital gain tax rate of 39.6% include the 3.8% Obamacare tax that was currently added to the ordinary rate of individuals?
So, Carol, very good question. And no, no. So the way the taxes are going to be, so like I said, the 39.6 is one tax, and then all these other tax proposals that are going to go on top of that. So when we talk about tax rate and effective tax rate, so let's say, for example, we have interestingly enough, in the House proposal, there's not the 3.8 Obamacare tax, but what there is they have the net investment income tax and the 3% surcharge, which I think is supposed to make up for the Obamacare tax. But let's say in that situation, if you have, let's say $5 million is I think the threshold for the surcharge, then you can potentially have, let's see, was it the 3.8 net plus 3%, so 6 points. So it could be an effective tax rate of like 45% or 45, 46% when you tack on all of the taxes together. So no, these are all separate taxes that are being imposed.
So in California, you have
plus the 13% in California. Yeah. Thank you. Thank you. I forgot about that. Yeah.
So wow, that's I mean, if you're talking, the federal rate 46 plus an additional 13 from California, you're pushing almost 60.
Yeah. I have I mean, one of the things that's been keeping me busy during the pandemic is I do residency planning. So like when people are moving out of California, how to do that appropriately so the franchise tax board does not chase you. I like to say this.
Now remember, Raul, this is being recorded.
Yes. I like to say this well, I used to work in residency, so I tell my clients, don't be afraid of the IRS, be afraid of but be very afraid of the franchise tax board.
Got it. So that's a specialty of yours, working with folks. I know a lot of the agents, on this program have clients that are moving to Texas and other more tax-friendly states.
I just helped 3 agents from California move out of California. Isn't that funny?
All right. Carol's second part of her question, Maggie, over 100,000 for a trust. Can you add more details about this 3% surcharge? Right.
So the surcharge, what did I say was the surcharge for the, let's go back to that.
Yeah, it was slide before. Sorry.
Did I miss it?
Keep going.
Okay. So here's the NIT that we talked about.
One more. There you go.
Okay, no, that's capital gains, right? So where's the damn surcharge? Oh, here it is. Okay. Yeah. So yes, so it'd be 3% for income inside the trust. So, the easy way to get around that is to make distributions out of the trust. So you don't, and one of the things because do you see how big the difference is between the income for individuals and trusts? Because what the Biden administration has been trying to do is kind of like chip away at the use of trusts to basically circumvent paying taxes. One of the provisions that was not on here, but they were, one of the proposals was to get rid of what's called the Dynasty Trust. The trust is that lasts basically forever. So the way these trusts work is they're not made in California, because California, you can only have a trust that lasts 99 years. So you'll set up in like South Dakota, Wyoming. And what you do is have these trusts that just basically, live on forever. This is when you think about like the rich people in trusts, like the Vanderbilts and the Rockefellers. These are the kind of trusts we're talking about. And what's happening now is that in the Green Book, the proposal from Biden was that after 99 years, the trust is treated as if it sold all of its assets. So what they're trying to do is prevent, what the White House is trying to do is prevent the use of trust to shield income from various taxes. That's why that's one of the reasons why it's so much lower than the other rates.
Got it. All right. Our anonymous attendee asks about section 179, deductions and large vehicles over 6K.
Oh, good question. Buy vehicle. I told my clients, buy your vehicle now. So that deduction was supposed to be, and I say that in quotes, supposed to be for like farm equipment, like or big F-150 trucks. So if the trucks are used for, if the vehicle is within those parameters and it's that weight, then you can use this 179 deductions for that, and that's going to go away. There's no way they can justify keeping that one. But yeah, so I think that's before the year's out, get yourself one of those SUVs. So for like an individual, it'd be an SUV, because so it goes by weight, right? So usually, big trucks and SUVs were the ones that qualify.
Got it. And you think that might go away?
Yeah, I've had all my clients, my business clients, they're all like, sporting F-150s or like SUVs now. So just saying.
We have a couple of Prop 19 questions, and I kind of like to lump them together because I think it'll be easier for the question or for the answers to come all at once from you. So I'm going to read through them and then we'll just kind of address them. First of all, in talking to you, I know that you're not a fan of Prop 19. I also know that Carr was a big proponent of Prop 19 because specifically of the transaction volume that was supposed to occur because of it. However, for generational wealth and to keeping property within the family in a manageable way, it is not the most favorable proposition. So anyway, with those two things in mind, I'm going to read these questions. Prop 19 is the $1 million plus assessed value. Is the assessed value the property tax base at the assessor's office, or is it assessed at the value of time of death by way of an appraisal? So that's one part question. Can you chat? Another part is, can you chat a bit about Prop 19 and the value transfer? Prop 19 seniors can keep their tax basis no matter what the value of the property is. Can you talk about the value of Prop 19 to people over 55 who sell their residence and move somewhere in California and transfer their property tax basis? This seems to be a valuable asset and proposition for seniors who will remain alive and in the home long term. And I think that is it in regards to the Prop 19. So basically, how is the value of a property assessed with Prop 19? And can you speak to the value of Prop 19 for those 55 and up who are receiving the most benefit from it?
Right. So for the valuation issue, it would be the assessor's office unless the estate has a valuation of their own, and then you would just basically present that to the assessor's office. So it's one or the other, but one would want, I guess, in that situation, the higher valuation. So I would get my own evaluation for, especially in the Bay Area, for property at date of death. And there's like an election, usually date of death or 6 months after. I do it 6 months after. Well, yeah. So Prop 19. If memory serves me correctly, the way it was drafted originally, it was for the base value transfer situation for people over 55, and there were fire victims. The parent-child exclusion was added after. And in fact, if I'm not mistaken, I think what one of the proposals to put it back on the ballot is to actually keep the base value transfer language, but take out the parent-child exclusion for primary homes and investment properties. I guess so. Yeah, I mean, is the question what is the value of that? I think that.
From a taxpayer standpoint, the value is that you keep your property tax base, and if it's low, then
yeah. Oh yeah, yeah.
moving forward, yeah.
Yeah, yeah, absolutely. That's
yeah,
yeah. And there's various techniques there's certain planning techniques where, let's just say that you could move properties under people who are over 55 years of age. There's certain planning techniques that can be used to do that. But yes, that is the value, is like, if you're 55 or older, that is a very valuable benefit for this, and fire victims too. And that's who it was intended to be for, not, the other part was added afterwards. But yeah, I don't know if I answered the question, but yeah, it's a very big tax savings. And one of the things now when I'm planning for clients is, we always look at the property tax. But like I said, for me, because it's the way I plan for my clients for property transfers, is real estate transfers, I should say, is that it's in the back of my mind, but it's not something I'm really I don't focus too much on it, because we're looking at, where this applies is apart from, there's two ways this happens, right? We know that property reassessment happens when a parent dies and leaves their kids property, or when there's a transfer. So what I focus on is the doing the transfers through. There are ways to transfer real estate without triggering Prop 19. I guess that's what I'm trying to say.
Okay, that's good to know. and
I'm being recorded, so I can't give away all my tricks.
Yeah. We'll call you if we have that. So I just want to be clear that it is a little past noon. Our schedule today was from 11 to noon. Raul, do you have a few more minutes to answer a few more questions? And then audience, it is noon. I want to be let everyone know that we have reached that time. So if you need to jump off, but if not, stay on. We'll answer these couple more questions. If you have any other questions, put them in now, because we're going to cut off questions very soon. All right. Lewis asks, would you be able to go over SALT again, just briefly, what's currently in place and how, what changes you see that may come down the line?
Okay, so so state and local tax deduction is it's a $10,000 cap, right? And what's happening? Let's go back to it. Oh, and Patrick, someone notified me that there's my email address was put there incorrectly. Is there any way you can fix that? Yeah, so right now we have a $10,000 cap, right? So what's happening right now, it's all like, this is all politics. And what's happening now in the House is basically trying to come up with a compromise. What really kind of screwed this is a certain senator from Arizona's reluctance to raise the corporate and/or income tax rates. So they're having a very difficult time coming up with the money to pay for this, right? So like if you see here on the screen, it's a 2-year repeal would cost roughly $180 billion, right? So what the House is likely to propose is basically not an outright repeal of the SALT deduction, but doing a compromise where they raise the limit to maybe 25,000. That's what's been discussed, and they do it for a longer period of time. Otherwise, because one of the proposals was to do a 1-year repeal or a 2-year repeal, and the money wasn't there, and it's not a very popular deduction amongst unless you live on the coast, right? On the coasts. So yeah, so like it's called the SALT group, and it's representatives from New Jersey, New York, California. But I know that Senator Schumer and Nancy Pelosi are really fighting for this. So we'll see, because some Democrats say, from this group from New Jersey and New York and California, like if we don't get this, we're not voting for the reconciliation bill. So yeah, that's stay tuned for that one.
Okay. I dropped all your contact information in the chat, name, contact, and email. Next question is, I've heard there's a plan for banks to report to the IRS all
good question.
bank transactions over $600. Is that a treasury plan or a Build Back America or Build Back Better Act plan?
It's in Biden's proposal. That's not going to happen. It's most likely not to happen. It's going to stay at its current $10,000 level. And the reason being, part of it is like administratively, it's going to be a nightmare for the service. So, but one thing that this did bring up is that, and I tell my clients this, enforcement is going to go up at the federal level. What they have every year are like, they have their dirty dozen of things they go after. And so they pick certain transactions that are going to have more scrutiny. One of the big ones, like for example, cryptocurrency, they're going to be going after cryptocurrency a lot. And that's some of the, in fact, some of the proposals we didn't discuss today involve the monitoring, reporting of cryptocurrency. So I think, but even then, like, so if the service gets their additional money, and I think it's, I always tell people this, I learned this in the government, is that the reason why a lot of us pay so much in taxes is because certain individuals don't pay anything. So it's, what the service is trying to do is fill what's called a tax gap for those people that are not paying their taxes to kind of, come into line. And we haven't discussed it today, but a lot of the international provisions kind of go to that for big, large corporations that aren't paying anything to pay their fair share. So, I always say it's like, I'm okay with taxes as long as everybody pays their fair share, and they do not.
And that goes back to the international plan to tax everybody at least 15%, so that everyone's
Right.
kind of in the same boat, is it?
Yeah. And for this, even under the previous administration, the big, complex, insanely difficult provisions and the major changes are at the international, because as we go more global, these things tend to matter more and more. So yeah.
All right, 3 more questions, one of which you already started to answer. First question from anonymous attendee: can you elaborate on tax planning now and then the eye towards the possible elimination or cap of section 199A deduction?
Yeah, well, one thing I said earlier was, if there's a cap, or and the elimination is going to happen anyways, that's one of those phase out provisions that's going to happen too, I think 2026, is that, like I said earlier, one way is if there's any way to kind of like book income this year versus next year, that would be great, because it's going to be, you're more likely to benefit more from the 20% deduction this year than starting next year. That's one. Two is, and this takes, and this is also dependent on what happens with the corporate tax rate, because if it remains the same or similar or close to, then maybe thinking about a change of entity change, because if and I mean, there's a lot of stuff that goes into it, like, but if, for example, like examples, if you, let's say that you have a business where you're basically reinvesting everything. It's much better. And let's just say the corporate tax rate maybe goes up maybe to 25%. It still might be better for a taxpayer to be in the corporate form because you'll be taxed at 25% versus the new 39.6%. And because you're reinvesting everything into the company, you're not, getting the double tax. You're not distributing any of the proceeds out to a shareholder, right? So maybe thinking about the change of entity, what kind of business entity you're using now, and whether it's the best one for you. So that's kind of what I do a lot in planning, is like, are you in the best possible vehicle in order to conduct your businesses or what have you?
Our next question has to do with vehicles. Will you be seeing more charitable remainder trusts if these new tax provisions come into play?
Yes. In fact, yes, that's yeah. In fact, I have an appointment afterwards to talk about a charitable remainder trust. Yeah, but they're also, and and it's going to sound like I'm ping ponging back here a little bit, but like some of the proposals in Biden's proposal in the Green Book were to basically reduce the charitable deduction. Now, so that's one. Another one is, one of the things that the IRS is also going to be looking at is charitable remainder trust. So, I was just talking to a client this weekend. It's like, the important thing is to, in all of this, it's with careful planning and following the letter of the law, you can avoid a lot of the, you can reduce some of the hurt that's going to be coming. And like so charitable remainder trust, yes, I think they'll be increasing, but I have also seen them on the government side where they're used very abusively. So that's why I think the enforcement comes into play. But I think, yes. So to answer your question, yes, but also be careful because they're also going to have more scrutiny.
All right. Our last question has to do with cryptocurrency, as you were bringing it up earlier. Well, this actually brings up another conversation about enforcement, right? So I know the IRS has had a lot of new hires. There's a whole new branch of the IRS. How are you seeing them aggressively, go after and look for tax evasion? We know that, crypto is not a regulated asset as of this date. It may be regulated in the future, but right now it's a way for many people to, or some people to, money launder. So, how is the IRS enforcing cryptocurrency taxes, and how are they monitoring the process?
Yeah, so what they're doing is they're beefing up a few things. So one of the things is when the way the transactions work in crypto is now, I'm looking for the proposal right here because it just came out. But okay, there's something called constructive sales. So in tax law, it's basically when you're treated as selling something, even though you might not have gotten rid of it. So on a lot of these blockchains and exchanges, when you're acquiring and disposing of coins, there's very specific instances where those transactions actually will constitute a sale. But now what the one of the proposals is, whenever there's unless you're just buying a Bitcoin, or for example, transactions on the blockchain are going to be constitute sales, and you're going to have to report them, almost like stocks. And another thing too is that there's going to be reporting requirements coming out for crypto. And another thing is that the SEC and the IRS are getting together to kind of like form a
task force.
Yeah, task force to monitor this stuff. And that's coupled with the fact that, a lot of people don't do this, but until it's too late. But if some of your blockchain is in a foreign jurisdiction, that you're required to report that already. And if you're not, it's called FATCA. And it's basically, if you're over $10,000 in an account in another jurisdiction, you're required by law to report it. And so they're going to be cracking down a lot more on reporting on foreign assets. And this goes to crypto, and it also goes to like the whole thing about global enforcement of tax compliance. And separate reporting requirements for cryptocurrency. And one of the proposals, it's the constructive sale rules that the Biden administration is proposing.
And any strategies to deal with cryptocurrency in regards to tax planning?
Well, yeah, I mean, I think, and this kind of goes to not just crypto, but I think everything is, I think that it would be good to start tax planning, like this, at the end of this year is going to be very important, I think. We'll know more in December, but I think that, like, for example, let's say the capital rate goes up, right? Maybe now is a good year to get rid of, to basically sell off stock, because the capital gains rates this year are going to be less than next year. And by the way, cryptocurrency is taxed at capital gains rate. So maybe getting rid of crypto this year, selling it versus next year. Yeah, depending on how things are going, it's right now is the prime time to start planning. Like even though I said earlier, I'm not really worried about Prop 19 too much. I really do, with my clients, plan for worst case scenarios. That way, if it doesn't happen, then you're good. But if it does happen, you're prepared, right? And I think that for a lot of these changes that are coming, I think it's not a bad idea to sit with an advisor and see about, based on your tax bracket and your assets, what you can do to kind of mitigate some of the changes that are coming, the negative changes that are coming.
So real estate agents who are out there who have clients that may be considering a sale of crypto, a sale of private stock, a sale of property over the next 2 years, guess what is a good time for you to reach out to Raul? Right now, before this stuff gets set up.
So, well, I mean, what's funny is, like, even for real estate agents, for sellers agents, I mean, the amount of taxes that are going to be piled on next year, maybe selling this year is a better idea than selling next year. That's a residence, for instance. So yeah, I just think it's a good idea to start preparing now than wait till it's too late.
All right, everybody, thank you very much for tuning in today. Raul, thank you for providing so much of your time. I know if we were doing by the hour, it would be a couple $1,000 we'd already run up. But again, thank you for being a part of our program today. Maybe we'll have you back, at the midpoint of December to give a brief update on the things that you've talked about and, kind of have finalized or how things have been finalized in Washington as in regards to the tax plan and BBB moving forward. So thank you all for tuning in, and thanks, Raul, for giving so much of your time freely.
Okay, thank you. Thanks, everybody.